Interest rates might seem like a distant policy decision made by central banks, but they quietly influence almost every financial market in the world, including Bitcoin. To understand why Bitcoin often rises or falls when interest rates change, we first need to understand what interest rates actually do. Interest rates are the cost of borrowing money. When central banks raise rates, borrowing becomes more expensive. When they lower rates, borrowing becomes cheaper. That single change affects the entire financial system. When rates are low, money is easy to access. Companies can borrow cheaply, investors can take more risks, and liquidity flows more freely through markets. But when rates rise, the opposite happens. Borrowing slows down, investors become more cautious, and money begins to move towards safer assets. This shift is one of the main reasons markets react so strongly to central bank decisions. Higher interest rates increase the returns on traditionally safe investments like government bonds. Suddenly, investors have a new option. Instead of taking risks in volatile assets, they can earn steady returns from safer places. That often pulls capital away from riskier markets, and Bitcoin sits at the extreme end of the risk spectrum. Unlike bonds or savings accounts, Bitcoin produces no guaranteed yield. Its value comes from market demand and long-term scarcity. So when interest rates rise, some investors move their capital away from risk assets and towards safer investments. That can create downward pressure on markets like stocks, technology companies, and Bitcoin. But the relationship works both ways. When central banks lower interest rates, borrowing becomes cheaper again. Liquidity begins flowing back into the financial system. Investors start searching for higher returns, and that money often moves toward risk assets. Historically, periods of lower interest rates have created powerful rallies across markets. Stocks surge, venture capital expands, and speculative assets often rise the fastest. Bitcoin has frequently been one of the biggest beneficiaries during these periods. Because when liquidity expands and investors become more comfortable with risk, Bitcoin's limited supply and global market make it extremely sensitive to incoming capital. But interest rates are only one part of a much larger system. They influence liquidity, credit expansion, and investor behavior across the global economy. And when those forces shift, Bitcoin often reacts. Understanding this relationship helps explain why central bank announcements move markets so dramatically. But interest rates alone don't tell the whole story, because behind them lies an even larger force that drives global markets: liquidity. And understanding that force may explain some of the biggest moves Bitcoin has ever made.